rising mortgage rates have pushed affordability to the lowest levels that we've ever seen in history. And with that, I think it's fair to say that mortgage rates are driving the housing market. As interest rates go up, you're likely going to continue to see home sales crash and home prices move down slightly. But on the flip side, if mortgage rates start to reverse and start to come down, you're going to see more and more demand come back to the market and likely see housing stabilize even further. So what does the future of interest rates look like? And how are they going to impact the housing market? Well, that's exactly what we're going to dive into in today's video. We're going to talk about what's currently happening with rates, what's likely to happen with rates, and how if you're waiting on the sidelines, you might end up regretting that in the long run. Now, before we dive into today's content, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, subscribe to the channel if you want to stay updated on everything mortgage rate, housing, and finance related. So when it comes to mortgage rates, we've seen a lot of volatility over the last couple of weeks. We saw mortgage rates hit the highest level that we've seen in nearly 23 years, sitting at 8%. But shortly after that, we saw the Fed come out and pause interest rates for the second consecutive time, which has led many people to believe that the current rate hiking cycle is likely over. And along with that, we started to see a few cracks forming on the employment front, with the jobs numbers coming in weaker than expected, along with a jump in unemployment going from 3.4% at the lows to where we sit today at 3.9%. If you're someone that follows history, anytime unemployment has jumped 0.5%, that's a clear indicator that the US economy is headed for a recession. And with that miss in the job numbers, we actually saw a big drop in mortgage rates, which in turn caused mortgage demand to stir back to life and mortgage applications to tick up after several weeks of declines. Now, I don't want to come off that everything has changed, because I do realize that we're working from really, really low numbers out there. So the fact that mortgage demand is coming up and applications are increasing, you have to understand the bar is really, really low. So any small increase is going to show an increase out there. But there is something I want to point out. Are you aware that every 1% change in interest rates either allows 5 million people to either be able to buy a home, or it actually keeps them from being able to buy a home? So if interest rates increase another 1% from where we currently sit today, somewhere around 7.5%, then that means 5 million people have just been removed from the buyer pool out there. So less competition in the market. And so as interest rates increase, that typically means less transactions out there happening in the market, in addition to more and more price cuts on the seller side. But as interest rates decrease, the adverse is true. As every 1% decrease, we actually add 5 million additional potential buyers to the market. Now, all 5 million of those buyers aren't going to buy a home, but the reality is it adds more competition to the market. And one question I get all the time from people are, who are actually buying homes in this market with interest rates sitting at 7.5%, 8%? Well, for one, I just did. I just closed on a property where I got an interest rate at 7%. And at the same time, I sold my home that had an interest rate at 3%. Now, you might be watching this video going, Jeb, you're absolutely crazy. Why would you do that? Well, for me, it was the right time in my life. I went from a 3-bedroom home to a 4-bedroom. I have 3 kids, a wife, and all of my boys are getting bigger every single day. And this property offered the location that we've been wanting for years. So for me, it was a sacrifice. Yeah, I didn't want to pay significantly more every single month for that property because of where interest rates are, but I knew as interest rates came down, more competition would come to the market, and the likelihood of me getting that property in the future was very, very slim. So I bit the bullet and decided to buy right now. Now, me aside, I had to get a loan to be able to buy this house because I didn't have the cash available. But with that, there's a lot of buyers out there at the moment that are sitting on tons of cash that really aren't affected by these rising mortgage rates. At the moment, cash offers for homes are at the highest level that we've seen in 10 years. That actually equates to 1 in 3 home buyers are paying all cash to be able to buy a property. In addition to that, many buyers out there are coming in with bigger down payments to help offset some of that cost of higher mortgage rates. The typical US buyer is putting 16% down when buying a home, which is the highest level that we've seen in about a year and a half. So something to keep in mind here, if interest rates continue to climb, you are going to see less demand out there in the market, and more sellers have to cut their price if they have to sell that home. Just like I mentioned earlier, but there's something I want to point out. Don't always pay attention to the media headlines. This headline right here came out of Fortune. It says the housing market is starting to crack. Sellers are cutting prices at record levels, which makes it read that more and more sellers are having to cut their price at levels that we've never seen before in order to get their home sold. But if you look at this chart here, you can actually see we're below last year, where 43% of sellers were cutting their price at the same time of year. This year, we're only sitting at 39%. But with that, you actually need some context to actually be able to understand that information. You have to realize that some of those sellers way overpriced their homes to start, so they had to reduce those prices in order to entice buyers to be able to buy them. In addition to that, some of those houses are complete garbage, need a full remodel, and might need everything. Therefore, those sellers also have to reduce their prices in order to entice buyers. And along with that, you're going to have some regular markets where homes just aren't selling. But for the majority of the US, that's not the problem, because currently US housing inventory remains painfully low. But here's the thing. You don't know what you don't know. And what I mean by that is I'm looking at all the economic data out there in the market, and to me, it looks like a slowing economy as inflation is coming down, jobs numbers are starting to get a little bit worse, which would lead me to believe that the Fed's most recent pause, their second consecutive pause, is the absolute end to their current hiking cycle. But with that, we don't truly know what the Fed is going to do. We have an idea of what they're thinking, as one of Powell's most recent comments says that he's not confident that they've done enough to bring inflation down. In fact, last week he re-emphasized some of his most hawkish comments. And with that, we actually saw some volatility in the market, as he said things like, if it becomes appropriate to tighten policy further, we will not hesitate. We will continue to move carefully and decide meeting by meeting. And he also believes that stronger growth could undermine the inflation progress, which in turn could warrant a monetary policy response. So the market got a little bit iffy after that statement, because even after coming out with two consecutive pauses and the overall market believing that was the end of it, Fed Chair Powell isn't actually playing that game. And we've talked about this in other videos. And the reason I believe that Fed Chair Powell is so stoic and has a complete poker face is because he can't lead the market to believe that they're going to do anything else but keep rates higher for longer. Because if he did lead the market to believe that they were going to start adjusting rates, or that that was the absolute end in rate hikes and that they might start to do something different in the future, well, that would likely cause businesses to go out there and start borrowing money again, which in turn would put money back into the economy, creating additional growth and likely leading to higher inflation. And that's exactly what the Fed is trying to avoid. And while I'm not a pessimistic person by nature at all, nor am I a contrarian when it comes to going against the grain, if you will, I just kind of look at everything that's out there in the market, with credit card balances spiking in the third quarter to $1.08 trillion, along with the Fed coming out recently saying that most American savings were going to be completely depleted by the end of the third quarter. And on top of that, you have student loan repayments that just happened, which in turn means less discretionary spending out there in the economy, because that money is now going to student loans versus getting spent on retail or dining or shopping or any other thing that could drive inflation up, which all these signs show me that we're headed for slower economic growth. And as the economy slows, there's just less money being spent out there in the market, and inflation will likely come down on its own. But even with that, you have members of the Fed like Bostic saying that the full effect of rate hikes is yet to come, more or less saying that we haven't even seen the full extent of what they've already done, which is something I've been saying for a long time. The Fed likes to pay attention to what's happening right now versus look a little bit further in the future and think about the long-term impacts of what they're doing. They did the exact same thing when they were talking about transitory inflation. Not until inflation got to nearly 9% did they get off that team transitory bandwagon and start to realize that inflation was a problem. And with that, they started to stimulate the economy. And they did the same thing on that front. They went too far for too long by not only giving people more money than they probably should have received during that period, but also by lowering rates and keeping them too low for too long, which is more or less added to the current problem that we have today, which is a lack of inventory. So while I don't believe that the Fed is going to continue hiking, I do believe that they're going to keep restrictive policy in place for longer than they should, which in turn is going to lead us into a recession, which is exactly opposite of what some of the Fed members are currently thinking, with Goolsbee saying that he believes that there's a golden path of a huge drop in inflation without a recession, which I think is absolutely crazy, because all of the economic data out there, aside from jobs remaining somewhat steady, supports the idea that a recession is on the way. But that's where I want to ask you guys. What are your thoughts? Are we headed for a recession? If so, why do you think so? And if not, why don't you believe? And there's also room for those soft landing thinkers as well. So do me a favor and let me know in the comments below. Now, I realize when a lot of people watch this, it can be frustrating, especially if you're a buyer sitting on the sidelines, because traditionally speaking, as rates increase more than double from the lows, you would have normally seen a big drop in house prices. But this time was different. And the primary reason for that is it always comes back to supply and demand. Now, while demand is super low, inventory is also super low. So the two are more or less in lockstep, which in turn has stabilized house prices. And that's the biggest problem out there at the moment, is because house prices have stayed high and interest rates have risen, housing affordability has gotten even worse. So the reality is something does have to give in order to improve affordability, to allow the number of transactions to pick up and the real estate market to begin to rebound. But with that, I want to go over a quick example. The median home price right now in the US is sitting at $394,300. And with today's interest rates of 7.5%, that's $2,757 per month. Now, if you compare that same price to a 3% interest rate from a couple of years ago, that payment is $1,662. Now, something to understand here, I didn't use a down payment, I just took the median home price and ran the numbers. But with that payment at 7.5% is 66% higher than the person that got that loan just 2 years ago. So for those people out there believing that rates are going to stay at, say, 7.5%, in order to get that same payment that somebody got a couple of years ago, home prices would have to drop nearly 40% to somewhere around $235,000 to be able to get that same payment. And the reality is that's not going to happen. So if you really want housing affordability to improve, you need to see interest rates come down lower, because interest rates have a bigger impact on your monthly payment than anything else. Now, I realize a lot of people out there are going to say, Jeb, I want the lower house price. I don't care about the interest rate. And I'll say that's simply not true for most people out there. While people say that, they actually do the opposite when they go buy things like cars. They end up leasing the car because the payment is less expensive. People are more worried about the monthly payment than they are the price, which is exactly why so much demand was pulled forward during the pandemic because of super low rates. People were willing to pay more money for houses because even though the house price was more than they wanted to spend, the payment was actually less because of interest rates. So for anybody sitting on the sidelines hoping to be able to buy a house, there's no world in which you're going to see a 40% crash in prices to get back to those levels. What you're more likely to see is home prices move sideways, interest rates improve, wages continue to grow over years, and in turn that will improve housing affordability. Now, it's not going to happen tomorrow, not likely going to happen next month. It's going to take some time because interest rates are likely in a slow grind lower, whereas home prices are likely to do more or less the same, move sideways to slightly up, slightly down, which unfortunately isn't what most people want to hear. Now, while I do believe interest rates are going to continue to moderate and go lower, there are some other things that are impacting rates that could cause them to go higher in the short run. And if you're curious to what I'm talking about, do me a favor and check this video out here.